Welcome to the January Spotlight on Insurance and Property Casualty coverage, brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Insurance and P&C is sponsored by Brokers International, one of the nation's leading marketing organizations. Experience the new world of insurance marketing at www.biltd.com. Directors and officers' liability coverage for financial institutions could soften next year due to more capacity entering the marketplace, according to brokerage Willis LTC. Currently, financial institution D&O coverage is one of the few remaining areas where rates continue to increase, and some institutions could continue to see higher premiums into the beginning of next year due to expensive reinsurance renewals from D&O insurers. Willis notes that financial institutions were hit particularly hard by lawsuits in the wake of the credit crisis and subprime mortgage meltdown. However, the hard market could improve over the next few years as new insurers write D&O coverage. In the meantime, the market will likely remain hard as underwriters remain cautious and look to increase premiums by 10% or even 15%, the report says. The U.S. property casualty industry experienced a larger profit during the first 9 months of 2009 than for the same period during the previous year, due to better underwriting results and recovery in investment markets, according to a recent special report by AM Best. Contributing to the improvement in underwriting performance was a relatively uneventful hurricane season, a large reduction in underwriting losses in both the mortgage and financial guarantee segments, and improvements in prior year loss reserve development. Additionally, credit spreads on fixed income securities tightened, while equity markets saw improvement as well. Net premiums written were down 4.8% to $325.3 billion for the period from $341.7 billion during the same period in 2008. Meanwhile, net income climbed to $17.3 billion for the period, up from $5.8 billion year over year. Finally, policyholders' surplus improved 2.1% to $504.7 billion through the 12 months ended September 30, 2009, up from $494.3 billion posted through September 30, 2008. The insurance industry will face increasing consolidation as a result of government intervention and potential changes to tax laws in the wake of the recent financial crisis, according to consulting firm PricewaterhouseCoopers, LLC. The firm also believes that stability in the industry is unlikely to return for several years as insurers attempt to adapt to regulatory reform. According to the company's analysis titled Emerging from the Storm, the Day After Tomorrow for Insurance, within 5 years the insurance industry could be quite different, and insurance policies could be underwritten by a group of large, well-capitalized firms. Among the developments predicted is large regulatory changes stemming from proposed legislation to reform health insurance and increase federal oversight of both the insurance and financial industries. PwC said that the insurers most likely to find success in the new insurance world are those that closely monitor developments and adapt their business strategies to include the most likely possibilities of reform. I'm Paul Wilson, and thanks for watching this Spotlight on Insurance P&C. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.